And the latest ADP pulse is flashing red. For the 4 weeks ending October 25th, private sector jobs turned negative. That's right, an average loss of 11,250 jobs per week, the first outright contraction since ADP began the series. The line on the chart is sliding downward from modest growth in September to steady decline through mid and late October. That's not a blip. That's a trend. When you zoom in, the damage is pretty broad. Every major industry and region showed weakness. It's not one sector dragging things down, it's the whole field. Momentum hasn't just cooled. It's completely reversed. That means November's data will likely show another negative print, making it 2 strikes in a row. At that point, the Fed will have no excuse not to see the obvious. And this is why trend matters more than headlines. ADP and BLS numbers never match perfectly, but their direction trends always converge. When ADP turns negative, BLS follows within a month or two. That's the tell. Right now, the tell is flashing warning lights. The pulse data also lines up with corporate earnings calls and PMI surveys, all pointing to slower hiring. Tighter budgets and workforce optimization, that's Wall Street code for layoffs. Meanwhile, consumer sentiment is cratering with households expecting higher unemployment. Fear on both sides of the economy, employers and employees, is how a soft landing becomes a stall. If the NER pulse stays negative through November, it means the private economy is contracting in real time, even if official data hasn't caught up yet. That will put massive pressure on the Fed ahead of the December meeting. They can't claim no evidence anymore. The evidence is being emailed to them every Tuesday at 8:15 a.m. This is what real-time economics looks like. The Fed wanted signs of cooling. Now they're getting a chill.